And what is going on, everybody? Welcome back to another educational video. Today we are going to be going over fair value gaps, and today is October 10th, Friday. So if you go back in the price action, you'll be able to go to the exact day that we're going to also have an example on exactly how you could catch a trade using fair value gaps. So let's just hop straight into it. Don't want to yap y'all heads off. Let me put this face cam down so we can get straight to the chart. Fair value gaps, we're going to be using US 30 as the example for today because there's a very clean example. When it comes to fair value gaps, you got to understand, when we have a lot of volume in the market, we leave gaps behind. I'm sure you guys have seen gaps before. If you don't already know what a fair value gap is, I'm sure you've already seen an example of a fair value gap. You just didn't necessarily know it was a fair value gap. But this is an example of a fair value gap. When you have candles that are gap in between the first and the third. Direction doesn't necessarily matter. If I were to turn my chart upside down, regardless if these were bearish candles or if these were bullish candles, if there are three candles, and if this first candle was a bearish candle, if there are three candles and the first candle and the third candle have a gap in between them, it would be classified as the fair value gap. Where are fair value gaps? An example of one would be right over here. Let me actually put on this right here. An example of a fair value gap would be right here. Boom, gap, gap. This is a clean example of a fair value gap. Another example of fair value gap, right up here. Boom, boom. First candle, third candle. The wicks don't touch. It is classified as a fair value gap. Now that is easily found. We can find gaps all day long. Another example of fair value gap, right here, right here. These are all examples of fair value gaps. But at the end of the day, finding fair value gaps is the easy part. Once you know what a fair value gap is, you will see them everywhere on every time frame. Understanding what a fair value gap isn't the hard part. Being able to identify which are the high probability, which are going to be the fair value gaps that have the most likeliness of having a reaction, that is the most important thing. Now, you understand what a basic fair value gap is. The candles, they don't often be in the same direction. The first candle could be a bearish candle, the third candle could be a bearish, but if there's a gap in between the first and third candle, regardless of the direction, it is classified as a fair value gap. Not an imbalance. An imbalance is its own subject for its own video, not here, but this is a fair value gap. Now, like I said, direction of the candles don't matter. That's one of the biggest questions I get from students, from people in comments. Direction of the candle doesn't matter. When there's a gap in between the first and the third wick, it is a fair value gap. Now, when it comes to understanding high probability fair value gaps, this is key. I pay attention to higher time frame fair value gaps, not gaps on anything below the 1 hour. I'm paying attention to the 1 hour. I'm paying attention to the 4 hour. I'm paying attention to the daily, and I'm also here and there paying attention to the weekly. But you're never going to get weekly, not even never, you're not going to get weekly fair value gap rejections often. You're going to get them here, you're going to get them there, but you're not going to get them as often as you would 1 hour and 4 hour and daily. These are pretty often, every single day, every single week. You're going to get reactions off of 1 hour, 4 hour, and daily fair value gaps. Now, that is one variable of having a high probability fair value gap, but that is not the only thing that makes gaps high probability. The time frame, high probability, 1 hour, 4 hour, daily, weekly. But the next thing that is going to make a fair value gap high probability is the trend. When you're trading in the specific direction of the overall trend, when you're trading in the direction of, you're going to be more than likely to win a trade. When you have a fair value gap that is in the direction of the trend, the likelihood of it playing out when you're also trading at the right time, which is the last thing that makes it high probability, is key. What are the times for high probability fair value gaps to get traded into? London session and New York session. Those are the main two sessions that if a gap gets traded into around those times, and if you don't know the exact times, I'll even break it down for you. London session, the ideal times if you want to see a gap get traded into, is going to be from that 2 to 4 a.m. EST time. For New York session, if a gap gets traded into around that, I would say 8 to 10 a.m. is like the prime time. I'm only really on the charts from 9 to 10 a.m., but ideally 8 to 10 a.m. is a whole entire frame that you'll likely get the reaction. So 2 to 4 for London, 8 to 10 a.m. during New York. You could back test it all you want. I can promise you, you're going to find reactions. You're going to find trades getting rejections off of fair value gaps, off the higher time frame of the hour, 4 hour, daily, when it's following the overall trend during those times. And what do I mean following the overall trend? Let's just say, for example, this overall trend was bearish, right? Let's just say all these were 3 bearish candles. What makes this gap high probability now? Because when you understand that the overall trend has been bearish, you ideally are waiting for price to give a pullback to keep price going lower. Now, if the overall trend was originally bullish, this doesn't make as much sense to take a sell off of, because you're overall bullish, and this right here could have just been a pullback. So even though you're betting on the fact that it's going to have a long-term trend lower, if it was already been bullish, it just doesn't make sense. Hypothetically, if you're following the overall trend, say the overall trend was already bullish, not bullish, bearish, say the overall trend was already bearish, and then you leave a gap behind, being able to follow that bearish trend with this gap is going to be a lot more likely. So that's what I mean when you're following the trend with these gaps. You don't want to go against the trend with these gaps. I'm not saying it's not possible, but for example, all these gaps that we have marked up, these are areas that I would ideally be looking for sells, not buys. I would be looking for reactions to the downside off of all these gaps that we had marked up earlier. Why? Because the overall trend is bearish. So I'll go over it one more time. What makes these gaps high probability? The fact that they're on the higher time frame. When you're trading off of these higher time frames, the likelihood of you getting a reaction is far more likely. There's gaps on every time frame, the 1 minute, the 1 second, the daily, all of the above. There are gaps on every single time frame, but you got to understand the ones that are going to have the most likeliness of having a reaction are going to be the ones on the higher time frame when you are following the trend. Say, for example, how do you follow the trend? If you're trading New York session, you got to ask yourself these couple of questions. What did London session do? Then after you ask yourself what London session did, what did the previous day do? If you can get a trend that follows both of those, more than likely New York session will follow that same trend. Same thing when it goes for London. If you want to understand what the trend for London is, look at the previous day. Look at what the previous day is doing, because the likeliness of us following the trend that's already been happening is far more likely than just today being a day that we actually reverse. And then what are the times that you're paying attention to? If you're trading London, you want to be on the charts from 2 to 4 a.m. If you're trading New York session, you want to be on the charts from 8 to 10 a.m. because that is the times we're going to get the most volume. It doesn't matter if we have a gap. Like I said, we want to trade into the high probability gaps. And the fact that if we trade into a high probability gap at the right time, the likelihood that we're going to get a move is far more likely. So now I want to show you guys an example. You had enough time to be able to screenshot that, do whatever you do. But an example for today of a gap. The main thing I'm also going to give you free game on. So free game. What else will make a gap high probability? Time, right? And what is another meaning for that? If we find a fair value gap that has got created during a high probability time, for example, what do high probability times bring? Volume. What creates gaps? Volume. So during these high probability times, for example, 2 to 4 a.m., for example, 8 to 10 a.m., we're likely going to get volume. And if we get volume during these high probability times, we're more than likely going to leave gaps behind. So if we leave gaps behind that got created during New York or London session, the likelihood of us having a reaction off of those, whether it's the same day or later day, is far more likely, because that move is based off of volume, and nothing moves the market by accident. So when we have these 100-point moves, it's not random. That is big money behind it. So these gaps that get created are important. So what time? I'm not even going to say what time, because I already see what I'm looking at. First thing I'm going to do is I'm going to mark up previous day's high, boom, previous day's low, boom. What is the trend from the previous day? The previous day's trend is obviously bearish. We can all see the previous day's trend is bearish. The previous day before that was also bearish. So ideally on a day like this, we are looking for sells. If we're trading New York session, okay, where are all the gaps? The main gap that I see is right over here, and it's so fucking simple. It's the only gap that I see. It is literally the only gap that I see, and I'm on the hour time frame, the bare minimum time frame for me to see these gap projections. And you can see how price rejected off. It's like, this isn't random. Keep in mind, overall trend, bearish. We left the gap behind on the 1 hour time frame, and we continue the trend is lower. I'm not saying that this is literally the only reason behind the trade. There's other reasons behind this trade. If I were to also pull a fib from this high to this low, I can more than likely get a fib rejection also. But this video is simply just to be explaining the fair value gap. When you follow these fair value gaps, you want to follow it with the overall trend. If I am bearish, I'm ideally looking for price to retrace higher into a gap to keep price moving lower. If I am bullish, I'm ideally waiting for price to retrace lower to keep going higher. Keep it simple. If I'm bearish on a Friday, where am I going to look to target? Lower prices, Asian session low, London session low, the previous day's low. That's the reason I mark up the previous day's high and low, because if we're bearish, what are the chances we go for the previous day's low? Far more likely. The previous day was bearish, we went for what? The previous day's low, right? You can see that. Same thing. This day was bearish, Friday, we went for what? previous day is low. I mark those up because those are high probability areas. The same reason I have high probability for value gaps, I have high probability targets. Previous day's highs and lows is one main one. And it's also one of the big identifications for the trend. Bearish, we're likely going to target previous day's low. So now it all comes down to is finding a way to be able to enter the market. Up here, if you were to be able to catch this trade, it is very simple because all it did was reject that gap and it literally fell. I don't even know how much it fell. 1,000 points it fell. 1,000 point drop off of this 1 hour for value gap. And I'm not saying you could have caught that entire trade, but the main thing is understanding why price had this reaction. When you think of the market, when you think of fair value gaps, think of it like painting a wall. When you're painting a wall, it's not going to be thick paint forever. It's going to slowly go away. So what do you got to do? You got to put the paintbrush back in the paint, go right back down, fill it in before going right back up. Put the paintbrush in the paint, fill it in, go right back up. Put the paintbrush in, fill it in, go right back up. That's exactly what the market is doing off these fair value gaps that get left behind within price. It's going back into these gaps that get left behind, filling it in before continuing to go direction. Leaves in more gaps that more than likely will have higher time frame gaps, will have daily gaps, will have the higher time frame ones, because when you're in a lower time frame, you have big moves, you're going to get a lot of gaps. You don't want to have a situation where you're asking yourself, which one should I trade off of? You want to have it simple. The highest probability gaps are going to be the simplest gaps. This is the bare basics of how to use fair value gaps. And if you guys have any more questions, just let me know. I'm here to help you guys. If you have any questions, comments, concerns about anything when it comes to fair value gaps, anything when it comes to anything trader related, let me know in the comments and I can make a whole video on it. I can answer you in the comments, whatever it may be. I don't want to spend too much time. This was honestly just a random thought. I just wanted to give you guys some game on fair value gaps after just observing what happened today. And it's Friday, so kind of just, filling myself with activities to keep myself busy until Monday when the market's open again. But fair value gaps is one of the main things that I use nowadays. I used to use a lot of different concepts, but fair value gaps is one of the things that I use and all my students use to be able to make the money that we make. All the live trades that you see me use, 90% of them are using a form of a gap. And you can go check them all out. I have a lot of free videos on this channel. But with that being said, I appreciate your time. If you want to work with me one-on-one to get access to the daily live trades so you can catch trades like this with me every single Monday through Friday, 9 to 11 a.m. We're trading every single day, educational calls Sunday, Saturday, every single weekend, every day, nonstop, trading course, all that, everything you need. You can apply to work with me in the first link in the description. But with that being said, I hope you enjoyed the free game, and I'll see you guys next video.